Welcome to another episode of Management Unplugged by GR. Today we are diving deep into a really high-stakes corporate dilemma. We're talking about a situation where a powerful CEO trying to save her company from, well, the brink of disaster used the Balanced Scorecard.
The ultimate tool for clarity, supposedly.
Exactly. Only to find herself looking at results that were just completely contradictory. We're digging into the tough choice facing Ellen Bright, the CEO of Transworld Auto Parts, or T-Take.
Oh yeah, this is a fascinating one. It's leadership under, extreme pressure. T-Take, a $6.6 billion auto parts maker. And by late 2008, they'd been absolutely hammered by the automotive recession.
Hammered is putting it lightly. They were bleeding cash, weren't they? The financials were just grim.
Grim doesn't even cover it. Massive operating loss. I mean, think about it. A net income loss of $455 million around that time, just hemorrhaging money.
And the parent company wasn't exactly sitting back patiently. Ellen Bright got this, frankly, terrifying ultimatum. T-Take had to hit a positive 8% return on capital employed ROCE by 2011.
And you really have to get the scale of that ask. They were currently running at negative 15% ROC. That's a huge swing.
A 23 percentage point turnaround.
Yeah.
In under 3 years, fail. And the company gets shut down or sold off. Simple as that. Stakes couldn't be higher.
Right. So Ellen Bright, facing this, existential threat, she reaches for the Balanced Scorecard, the BSC. This was about 6 months before the results we're looking at.
And why the BSC? Wasn't the pressure all about the financials?
Well, exactly, because the pressure was all financial. She knew the natural reaction would be panic. Short-term cuts, slash everything, which inevitably guts the long-term health of the business. The BSC was meant to stop that, to force a balanced view.
Okay, makes sense. So she reorganizes TAP, focuses on just two core segments, the ones with a real shot at profitability. The first is luxury. Think high-end European car makers. It's all about innovation, top-tier tech, perceived quality.
Prestige, basically.
Yeah.
And the second segment, economy. This one's aimed at the huge growth potential in Asia, but with a twist in strategy.
Yeah, this wasn't just about being the cheapest, right?
No, not at all. That market's crowded. Bright's angle was quality plus a low lifetime cost. Durability, reliability, that was their differentiator.
Okay, two distinct strategies. And then the BSC results come in after 6 months.
And this is where it gets confusing. Even though the tool is working, the results from luxury and economy, polar opposites. One looks fantastic financially, the luxury guys, delivering that cash flow the parent company desperately needs.
And the other,
economy.
missing every single financial target.
Yeah.
Looks like a disaster on paper.
But, and there's always a but in these things, when Bright looks past the dollars and cents, looks at the strategic stuff, the non-financials.
The whole picture flips. Luxury. Starting to show some cracks in the foundation, strategically speaking. Economy. They are absolutely nailing every single operational and training goal, just crushing it.
Wow. So who did better? The one making money now but maybe sacrificing the future? Or the one losing money now but building for tomorrow? That's Ellen Bright's puzzle. Which division president gets the pat on the back? Which strategy is right for TAP's actual survival? That's what we're going to unpack today, why this tool, the BSC, designed for clarity, is causing such a headache.
Okay, let's set the stage a bit more. Talk about that financial cliff Tiki was teetering on. Before Bright stepped in, things were messy.
Messy is generous, strategically scattered, financially just sick. The company was dragged down by these chronically underperforming segments. Looking back at those 2008 numbers, the losses in truck, in mid-priced cars, they were huge. Mid-priced alone lost nearly $400 million operationally. That basically wiped out all the profits from every other division combined.
Ouch. So they were just burning through cash.
Constantly. Net operating cash flow was negative $81 million that year. They were just running on fumes, really. Legacy operations bleeding out.
So Bright comes in, sees this diversification mess, and realizes radical action is needed, like amputation.
Pretty much. A surgical amputation, you could call it. She made the incredibly tough call to shut down the worst offenders. That meant closing facilities, mainly in the U.S., unfortunately. Painful, but necessary.
Because it freed up resources for the parts of the business that actually had a future.
Exactly. All the remaining focus, the capital, got funneled into luxury, serving those established European markets, and economy aimed squarely at that big Asian growth opportunity.
And this created those two very different playbooks we talked about.
Yes.
Let's just quickly restate their core aims. Luxury, premium price, justify it with cutting-edge innovation and that perception of superior quality. Be the best.
Simple concept, hard to execute. Now, Economy, that was trickier,
Yeah.
especially in Asia. They couldn't just be the cheapest. Local players already own that space.
Right, that's where the lowest lifetime cost idea came in.
Precisely. It's not about the sticker price. It's about the total cost of ownership. High-quality parts that last longer, need less maintenance, cause fewer warranty headaches down the line.
That's a more complex sell, isn't it? Convincing buyers to maybe pay a bit more upfront for savings later.
It absolutely is, and it relies entirely on operational perfection. You can't promise lowest lifetime cost if your parts fail or wear out quickly. You need extreme durability.
Which brings us back to the balanced scorecard. Bright needed that operational perfection, especially for economy.
Yes. She knew if economy just chased short-term financial targets, they'd inevitably cut corners on quality, on the training needed for things like TQM and JIT total quality management, and just in time. Those are foundational for low lifetime cost.
So the BSC was meant to enforce patience, to keep the focus on building those capabilities, even when the financials look bad.
Exactly. It's designed to balance the short-term financial pressure, which was immense, with the long-term strategic necessities. It tracks both.
How does it do that? You mentioned perspectives.
Right. The classic BSC has 4 perspectives. Financial, that's your lagging indicators, the results like profit and cash flow. Then customer, how do customers see you? Then internal process, what must you excel at internally? And finally, learning and growth your people, systems, climate for action. These are your leading indicators.
This is lagging, okay.
And Bright's key point was, these aren't separate boxes. It's a cause and effect chain. You invest in learning and growth, like training, that improves your internal processes, like quality, that satisfies your customers, which then eventually shows up in the financials.
Eventually being the key word there.
Absolutely. That chain takes time to play out, and that's where the confusion starts when you only look at a snapshot like 6 months.
Okay, this is getting good. Let's look at the results, starting with the luxury division, led by Aaron Eckhart. You call them the short-term sprinter.
Yeah, the sprinter. Because, man, they just bolted towards that financial finish line. They delivered the kind of immediate results that Ellen Bright desperately needed to show the parent company something positive.
What was Eckhart's philosophy on the scorecard?
He was kind of a minimalist, advocated for a simpler scorecard. His thinking was basically less is more. Keep employees happy, they'll keep customers happy, and that leads to happy shareholders. Pretty linear.
So we focus more on the outcomes, financials and customer stuff.
Seems that way. Those are inherently the lagging indicators, the results you see at the end. And looking at Exhibit 10A, the financial results, wow. It must have been a huge relief upstairs.
Oh, good, are we talking?
Remember, TAP overall was deep in the red. The luxury division's own target for year-to-date operating cash flow was still negative, minus $12 million. They were budgeting to lose money for the first 6 months.
Okay.
Instead, they delivered positive $8 million in operating cash flow.
Wow, that's a $20 million swing from the target. That's huge.
Huge doesn't cover it. It's more than just accounting. It's a political lifeline. It sends a signal. We're stamping the bleeding. That's critical when you're facing that 8% ultimatum.
And profitability.
Also good. They targeted a 14% gross margin. They hit 15%. So purely on those 6-month financial numbers, this division looks fantastic, super efficient delivering the goods. The sprinter definitely crossed the finish line first.
Got the financial gold. But, you hinted at a but, this is where the BSC starts showing the other side of the coin.
Exactly. Because the luxury strategy isn't just about short-term cash, it's built entirely on premium pricing, which demands flawless quality and continuous innovation. If they hit those financial numbers by sacrificing that foundation,
Then the win is temporary, maybe even damaging long-term.
Precisely. And the leading indicators, the strategic stuff, suggest that might be happening. Look at quality. Their goal was tough. 3 parts per million defects. 3 ppm. That's world-class what luxury car makers expect.
Okay, and what did they achieve?
They came in at 5 ppm.
5 ppm is still pretty good in absolute terms, isn't it?
It is good, objectively. But compared to their strategic target of 3 ppm, they missed it by 66%. For a division selling itself on technical perfection and premium quality, that's a worrying trend. How long can you command premium prices if your internal quality is slipping?
Right, that's the potential time bomb the BSC is flagging. It doesn't hit revenue immediately.
No. Quality slips show up internally first. Then later, maybe warranty claims creep up, customer satisfaction dips. Eventually, you might lose contracts. The Springer got the gold, like we said, but maybe tripped over that quality hurdle. Hasn't face planted yet, but the stumble is there in the data.
And what about the people side? The learning and growth perspective, Eckhart's happy employees theory.
Yeah, about that. The metrics there are also concerning and maybe explain the quality slip. Employee engagement, not great. The target for satisfaction with resources and training was an ambitious 80%.
And he hit.
62% on resources, 65% on training, both significantly below target.
Okay, so if you're smashing cash flow targets way ahead of plan, but your employees feel they don't have the tools or training they need, what does that imply?
It implies that maybe, just maybe, that financial win came from short-term belt-tightening, cutting training budgets, delaying hires, squeezing existing staff to work faster, not necessarily better. That eats away at your ability to innovate, which is luxury's whole game.
So Eckhart might be sort of robbing Peter to pay Paul, generating cash now by potentially weakening the division's long-term capabilities.
That's the risk, isn't it? He delivered that crucial $8 million positive cash flow, kept the wolves at bay for a bit, but the cost might be that strategic foundation starting to erode. It shows up later.
It's a calculated risk then. Secure the immediate win, accept some potential future damage.
Exactly. And Ellen Bright has to weigh that. Is that short-term lifeline worth potentially compromising the luxury brand's integrity down the road? Survival now versus sustainability later. Big question.
Okay, now let's flip the coin. The economy division, led by Kim Kwan, our long-term marathoner.
Yes, the marathoner. Putting in the hard yards now, building foundational strength for the long race ahead. But from the sidelines, watching the 6-month splits, their pace looks painfully slow.
Kwan had a different view of the BSC, didn't he?
Completely different. He totally embraced the complexity, saw it like being a pilot, needing to monitor everything at once: altitude, speed, fuel, direction. He knew that nailing lowest lifetime cost in Asia required mastering complex processes like TQM and JIT lean, deep, fundamental changes.
And those changes cost money up front, which leads us to Exhibit 10B, the financial picture.
Yeah, and if you only look at the financials here, it's brutal. The cost of that strategic commitment hit the income statement hard. If Bright was just looking at the quarterly numbers, Kwan might look like he's failing. Badly.
How badly?
Pretty much missed across the board. ROCE was negative 12%, way off the negative 7% target. Cash flow was negative $14 million, missing the negative $12 million target. Revenue was $100 million short. Gross margin was 4%, targeted at 6%.
Oof. Burning cash, missing targets. How does Bright possibly sell that to the board? Especially with the 8% ROCE deadline looming. Isn't losing $14 million just digging the hole deeper faster?
That is exactly the tightrope Ellen Bright is walking. She has to justify that burn rate. Is it a $14 million loss, or is it a $14 million strategic investment that hasn't paid off yet?
The BSC helps her make that case.
It does, because while the financials look awful, every single letting indicator, the process stuff, the learning and growth stuff, shows they're executing the strategy flawlessly.
Okay, let's talk about that strategic strength. The marathoners' solid groundwork. Their whole pitch is operational perfection leading to durability, right?
Right. And the proof is in the pudding. Quality metrics. They exceeded their target. The goal was 5 ppm defects. They achieved 4 ppm.
4 ppm, so better than the target and actually better than the luxury division managed.
Exactly. A 20% improvement over their own goal. If luxury slipping to 5 ppm was a concern, economy hitting 4 ppm is a massive win. It directly supports that lowest lifetime cost promise. Fewer defects mean lower warranty costs, longer life. It's tangible proof the strategy is working at the process level.
So the marathoners laying down perfect track. What else operationally?
They were systematically improving internal processes, supply chain, for example. They targeted a 26-day average delivery time from suppliers. They got it down to 25 days.
1 day doesn't sound like much.
Oh, but in a lean manufacturing world, that 1 day is huge. It means less inventory sitting around, frees up cash, makes you more agile. It shows they're genuinely shifting towards that hyper-efficient model needed for Asia. Less buffer, more perfection.
And the engine driving all this. The people investment, the learning and growth perspective. This is where that negative $14 million cash flow went.
A big chunk of it, yes. Kwan's view was everyone needed to live and breathe lean, TQM, JIT, and the numbers show they invested heavily and effectively. They beat their targets for TQM certified employees, 53% actual versus 50% target. Same for JIT lane training, 52% actual versus 50% target.
So this isn't just box checking training. TQM certification, that's a serious undertaking.
It's a fundamental cultural and operational shift. It takes time, effort, money. They are successfully rewiring the division's DNA.
So the argument is, yes, we lost money because we spent it here on training our people and improving our processes. And look, we have 53% TQM certified staff delivering 4 ppm quality. The financial loss is the investment cost.
That's the story the scorecard tells. And they backed it up with IT, too. They hit their target for a 20% increase in IT spending, and that wasn't wasted money. Employee ratings on information availability were strong, 45% actual versus a 40% target. The IT infrastructure needed to support TQM and JIT was being built and used effectively.
Okay. The marathoner's running slow now, financials look bad, but they're building the capacity, the systems, the skills for the long haul. Perfectly executing the strategy, even if the results aren't there yet.
You got it. Perfectly paved road for the future, but the construction cost is hitting the books right now.
So let's bring it all together. We have these two starkly different pictures. Luxury, short-term cash, but maybe strategic erosion. Economy, strategic perfection, but a big financial hole right now. And Ellen Bright is stuck in the middle feeling confused by her own scorecard. Why?
Well, like we said, the scorecard isn't failing her. It's actually doing its job perfectly. It's shining a massive spotlight on the inherent strategic trade-offs she has to make. The confusion isn't in the data. It's in reconciling these two valid but opposing realities. Management often wants one simple answer, right? The BSC is giving her two correct answers depending on the time horizon.
Reality one, luxury, the sprinter. That positive $8 million cash flow, politically vital, keeps the parent company calmer, buys time. But it might be masking that slip in quality, the low morale. They're potentially coasting on past investments, not building new ones.
Reality two, economy, the marathoner, missing financial goals.
Yeah.
Big red flag for the bosses upstairs.
But they are building that rock-solid operational base, TQM, JIT, 4 PPM quality. That's exactly what's needed to win long-term in Asia with their specific strategy. They're making the crucial future investments.
And the core tension is that gap, that time lag between the leading indicators showing up strong in economy and the lagging financial results that are still negative.
Exactly. It's all about timing. 6 months.
Yeah.
It's just not enough time for huge transformations like implementing TQM across the division to flow all the way through that cause and effect chain and boost profits. Think of it like a pipeline.
You put investment in training and processes in one end, learning and growth, internal process. That leads to better customer outcomes down the pipe. Customer. Only then, much later, does the improved financial result come out the other end, financial. That pipeline in manufacturing, it can easily take 18 months, maybe 24 months to really flow through.
So the economy division's loss right now is basically the cost of filling that pipeline. It's the investment required to get the future benefit.
Precisely. They're executing the cause side of the equation brilliantly. The effect, the profit, the positive cash flow just hasn't arrived at the end of the pipe yet. The loss is, in effect, a strategic investment expense.
Whereas the luxury division's gain, could it be the opposite? Pulling cash out of the pipeline now, maybe?
It could be. Leveraging existing resources, getting that immediate financial pop, but maybe not replenishing the source. The poor scores on resources and training, the slip-in quality, those could be signs they're draining the well, and eventually that will impact the financials down the line.
And looming over all this is the political dimension, the COO job. Bright knows one of these division presidents, Eckhard or K1, is probably next in line for COO.
Huge implications there. Her decision about who performed better over these 6 months sends a massive signal to the whole organization about what kind of performance, what kind of management she values most.
So if she rewards Eckhard, the sprinter,
she validates getting the cash now, pleases the parent company in the short term, but she risks sending the message that hitting financial targets justifies cutting corners on quality or skimping on training. That could be toxic for the culture, especially the one K1 is trying to build an economy.
And if she rewards K1, the marathoner,
she validates the tough, disciplined, long-term strategic execution. She signals that building capability, investing in quality, that's what really matters for T-Tape's future. But
that negative $14 million cash flow becomes even harder to defend. It could spook the parent company right when they're already on edge about the overall negative 15% ROCE. It might even accelerate the divestiture decision.
That's the razor's edge she's on. It's the reality of a turnaround. The BSE isn't the problem, it's the tool forcing her to confront this explicit choice. Short-term financial safety net versus long-term strategic positioning and sustainability. She has to look past the P&L.
She has to weigh the total health of the business, short and long term. The confusion isn't a flaw in the BSE, it's a feature, highlighting the difficulty and the need for judgment. And patience.
Yeah, patience and faith in those cause and effect links. Believing that the investments in economy will eventually pay off.
So this has been, wow, a really detailed look at how these tools force tough choices. The BSC didn't confuse Ellen Bright. It clarified the incredibly difficult trade-off she had to make to save TP.
In a nutshell, luxury's financial success might be hiding strategic weakness. Economy's financial failure is actually reflecting necessary strategic investment. The marathoner, K1, is doing exactly what the long-term Asian strategy requires.
But that 8% ROCE target by 2011 is hanging over everything, which leads to the final, really provocative question for Ellen Bright, doesn't it?
It does.
Given that absolute financial imperative from the parent company, can she actually afford to back the strategic marathoner, Kim Kwon? Can she take the political heat and financial risk, trusting those future returns? Or does the sheer survival pressure force her hand? Does she have to prioritize the financial sprinter, Aaron Eckert, even knowing it might compromise TP's future in that vital Asian market?
That decision, that's everything for Transworld Auto Parts.
A really tough call. But as you said, thanks to the BSC, at least it's an informed one. She knows exactly what she's trading off.
Precisely. Clarity, even when it's uncomfortable clarity.
See you later. Bye-bye.